Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. We finally got to the long-awaited day of the FOMC meeting along with Chair Powell's conference call. In last night's video, I said, will the Fed disappoint? Well, I would say not only did they disappoint, they failed drastically. There was nothing new, nothing that the markets could grab a hold of other than while Powell was talking, the algorithms were picking up on almost every word he was saying as the S&P rallied to the highs of the day. The second he stopped talking, the market started to collapse, and we kept going down until we closed negative with the S&P down 0.5%, NASDAQ down 1%. The interesting thing that came out of yesterday was that the Russell was up 0.9. Some of that rotation emerged yesterday, and it continues to be in the backdrop, but more on this later. But as we look at what the Fed said yesterday, he reiterated everything he said before. I've mentioned this in several broadcasts in the past. They have lending powers, not spending powers. And this is an emphasis that he makes every time he speaks. He's been saying this since the March announcement when they announced QE and they took rates to zero on the emergency meeting. This is a continuing dialogue. 3 times yesterday he said we will use our full range of tools to support the economy. He also stated that there would be increased asset purchases. But in the end, that does nothing for the economy. I mentioned this last night, that it takes the fiscal side. So let's talk about the fiscal side. You saw Pelosi and some of the Republicans all running around the street on TV shows and posturing that they're trying to put a deal together. There's a new deal between a Democrat and a Republican they're trying to put together, and it's all about posturing, but nobody's doing anything. Overnight, we're seeing the futures down 1% as folks just process what they heard yesterday. The credibility of the Fed is going right down the tube. And as I've said, without the fiscal response, what they're doing is meaningless. The other thing that is starting to happen that I've been talking about for about 4 weeks, maybe as many as 6 weeks, that the economic reports that we're going to see coming out this month are going to miss. We are expecting to see retail sales come up at 1%. They came in at 0.6. There's further implications coming from this that the economy is continuing to stall. And why is it stalling? Because the stimulus is running out and money is running out in the economy. So whether or not these politicians come up with something, if they don't do something pretty quick, it's going to be too late, and these markets are going to start to roll even more as the market sentiment will continue to deteriorate. Now, there's a number of things that I'll talk about tonight in the technical section that will be critical as we come into Friday. And remember, Friday is futures expiration. So we're going to see a lot of liquidation. I think some of it may have started already tonight, but there's going to be a substantial amount of activity in the futures market and a lot of arbitrage going on as we come into Friday's close. So expect a lot of volatility, especially with some of the emotion that's starting to flow out of the markets. The algorithms and machines are going to be turned on full tomorrow, so we're likely to see plenty of volatility. The big news for today, and I talked about this a couple of days ago, is going to be the claims number and the continuing claims. Now, claims are expected to be up about 800,000. Continuing claims, I haven't seen any real estimates on the street on this. Last month, uptick to, and now if we uptick again, I believe that's going to be even a further negative, throwing fuel on this fire as the market sentiment is beginning to crumble very quickly. But as we come into the end of the week, there's still plenty to deal with after this Fed meeting, as we're going to see a lot of posturing by the politicians, but they're not going to get anything done, and market participants get this. Let's take a look at the charts, see how they're set up for Thursday, and see if there's anything I can pull out for the end of the week as we come into this expiration. Reviewing the WaveTech database, the short-term models did see about 370 new buys versus 130 sells, but a couple hundred stocks out of 16,000 is not material. Currently, there are 13,567 stocks with no trends or no positions right now in the database. Only 2,961 currently have a position. As I've been discussing over the past several days, if we stay under 26% for another week, we're going to see a continued bear market. Several weeks ago, I talked about seeing a big rotation that was going to be healthy for the markets. But that all changed back on September 3rd when we had that giant reversal day, and the markets have changed since then, and we continue to see wave after wave of liquidation, primarily in the FANG stocks, but in the top end of the tech sector, and many others are seeing a negative rotation. But with this database collapsing all the way down to the 14% level, this is never a good sign, and it will take longer to recover from this once the market does stabilize. It will be very methodical in how the database will reset itself. Now, as I've talked about on the weekly models, we still have about 68% bullish, and what's going to happen there is we're going to see some rotation, and we're likely to see further liquidation as we come into Friday, just because of the weakness that we're continuing to see in the markets. There's nothing really going on material in the database to indicate there's anything that even looks like a bottom in this pattern, and we're going to continue to see a lot of pressure on the markets as we go forward for the next 2 to 3 weeks and possibly longer. Reviewing the S&P futures, overnight we've seen a drastic fall. From the time that I did the opening comments on the video, we've dropped another 1%. We were actually down to the 33.10 level. Last week we printed an overnight low at 32.85. It's likely we're going to print below that level if we close today below the 33.56 level, which is that 40-day moving average that I've been talking about. You'll recognize that the PPMs are accelerating. PPM 1 is now minus 0.75. PPM 2 is turned negative. PPM 3 is actually flat, but we're below the first and second derivatives on PPM 2 and 3. And the PPMs are the price pressure momentum. What they tell us is the angle of the attack or the angle of the trending of the markets. And in specific, PPM 1 is tracking the 10-period moving average. I mentioned that we are likely to stall right at that. With the comments from the Fed yesterday, we spiked above it yesterday, a huge range as we traded right at an R2 and printed down to an S2 value. We came just short of S2 on the close yesterday. If we had had another 5 minutes, we would have easily printed an S2. But the market closed. Now overnight, as I mentioned, we're seeing a substantial amount of weakness. We've actually taken out the STX number, which is 33.32, the low 33.10.25, and we're seeing a lot of pressure. This is about 15 minutes before the London Open right now, and the pre-London crowd came in and knocked this market down about 0.75%. And we're continuing to see some selling as we come into London opening. Looking at the cash S&P, the 40-day moving average 33.68, with the futures being down over 65 handles. We're going to print down toward the 33.20 level. Last week's low, the critical low, and I talked about this a lot, which was the 10-week moving average, we'll review here in a minute, was 33.29. That low will be challenged if we keep this weakness into the U.S. Open. Will be challenged on the Open on Thursday. Just a couple of days ago, it didn't seem very realistic that we would even be able to see a weekly S1. That's 33.05. That could be hit in the morning. The next number below this, if we take out 33.05, is 32.66. PPMs are at 0.60 on the 10-period moving average. That number is now 33.49. Last week it was 33.30, so it's up about 20 handles this week. If we penetrate through that and we close below that level on Friday, this will roll over. They've crossed their first and second derivatives, and my expectation will be that the PPM2 will start to turn down, but we're going to head toward the bottom end of this grid probably next week, only if we close under this 33.49 level on Friday. So I'll update the action that we get on Thursday for Friday's video to set this final pattern up. And as I mentioned, it is futures expiration coming this week, so there's going to be some substantial amount of arbitrage and activity. Algorithms will be turned on big time for today's session and probably going into Friday as this volatility continues to stay very high. Before I move on to the NASDAQ, just want to take a quick look at this Russell versus the NASDAQ. And this spread chart is going to continue to work. Even if the markets go down, you're going to see the Russell not go down as much because it has been underperforming, and the NASDAQ will continue to go down. Now, I won't cover any of these stocks, but on the live stream yesterday, I went through all the FANG stocks and a lot of the tech stocks, and they all look the same. They all look like they're going to their 21-day moving average. So pick your favorite stock and bring up a simple 21-day moving average, and that will give you some targets on what some of these stocks are going to do. It appears if the market doesn't hold this support on Friday, that we're going to be in for quite the week as we move into the final 2 weeks of the month of September. Just a quick glance, I won't mention what indexes are, but these are everything from Dow Jones, S&P, mid cap, small cap, all the indexes versus the NASDAQ, and you can see these spreads are just rocketing off these lows, and there's not one of them that's not working. I've been telling you about this spread for many weeks now, and this thing is starting to really light up, and this has everything to do with the tech rollovers. Next, we'll review the NASDAQ futures. Looking at the daily chart, I mentioned this last night, that the profile on the NASDAQ is much weaker than what is on the S&P, and this goes in line with the spreads I just covered. We're trading down overnight toward the extreme on the market grid at 10,975. We're 10,041. We're trading S3 right now. We're likely to continue down toward this low. It will be interesting to see if we get any kind of traction and support down at these lower support numbers. But it's very vulnerable right now, especially with PPM1 right now. You see it's just collapsing. And I talked about this last night and the last couple of videos, is that in spite of the small little rally back that we had, all of the equity markets, there was no indication that there was enough traction or anything to cause a bottom to be formed here, and that we were still seeing a deterioration in the PPMs as we went forward. But this is further sign, PPM 1, 2, and 3, all declining and all below their first and second derivative. And PPM 1 is a sharp acceleration. So now the 11,296, call it 11,300, is going to be major resistance. So any rallies up against that number will be an easy sell. Now there is going to be volatility. We're down 218 handles on the NASDAQ futures as we speak, and we're down 1.94%. So like I said, we're going to see the algorithms come in, plenty of volatility, and I would use the daily market grid to trade off of. This is the daily market grid, so you're going to be able to trade off of that. We're trading just below S3 right now, S2 at 11,112, S1 at 11,185. Those are going to be resistant points on any kind of snapback rally that we might see. But just as I'm doing this commentary, we're actually collapsing even more. We're down 222 now, so we're just accelerating as we come in to the London opening, about 5 minutes to go. The weekly chart on the NASDAQ futures, the 10-period moving average is 11,131. We're trading 11,036, so we're trading through that. The S1 number on a weekly is 10,852. So don't be surprised if we print that before we get to the end of the week. And the next level below that is 10,633. And if you go back, I believe we marked the timeline on the live stream yesterday when I covered Apple and some of these stocks, but you'll see that all of those stocks are in big trouble, and this is going to continue to keep plenty of pressure on this NASDAQ index. The next market I'll cover is the US dollar, and we're coming up against a resistance point, and it's interesting, while all the markets are collapsing, the US dollar is rallying, and gold is under a huge amount of pressure, which will be the final market that I cover tonight. But we're right up against this resistance point, 93.54, last trade 93.44. We get through this 54 level, then we're going to start to move up to the upper end of this grid between 94.19, 94.98. PM1 has crossed to its first derivative. PPM 2 and 3 are in bottoming phases. I've been talking about this for weeks. There's no explanation that I can find fundamentally why the dollar is going to improve, but it does appear that it's going to. Sometimes you can't figure out what's going on fundamentally, and it'll reveal itself. So right now the technicals are leading the way on the dollar, and we're right at a critical pivot point. We get above this number I just mentioned at 93.54. We close on Friday above that level, then expect to see further advances moving up toward this grid. Will start to slope slightly higher next week. So the ranges that you're going to be able to expect is going to be 94.50, maybe closer to 94.70 as we come into next week. It will all come down to how the market closes on Friday. The final market that I cover tonight will be gold. We're trading right on that support line, 1946. 1946 is the 10-week moving average. It's currently up at 0.68. I mentioned this in the last couple of videos that this is going to be a point to buy. Well, the good news is, you'll, at least if you decide to take a trade off of this 10-period moving average, you're going to have a close stop here. You don't want to see it move down below the S1 on weekly. So it is about a $20 risk on this trade, but the upside is so limited, I'm going to tell you that I probably wouldn't do a trade on gold right now. It's just way too risky. I would stay neutral here. I believe this support line will have some relevance, but we might spike down to the 1930 level, possibly even going down further into the grid, 1910. I don't think we'll see 1891. But this could be next week. If the dollar breaks out, this is why I would be cautious with gold. If the dollar does close over these numbers on Friday, you don't want to be long gold here. You want to definitely remain neutral. As we look at the daily chart, the bottom of the grid is 1943.60. We've hit the STX. The low tonight has been 1943.10. So basically an STX hit. We're trading at 51, so we bounced off of that level. So support levels appear to be holding, but like I said, I just don't see any really clean trades that you can make out of this area to actually benefit here, other than taking a lot of risk. Might be lucky buying these prices, but it's going to be very tenuous, and I think there's too much risk, especially with the configuration of the dollar. So I would remain neutral at least for another day or so, until we can see what's going on with the dollar and how it's going to close on Friday. So I would be very cautious with gold at this time. This will complete the video. I'm going to thank you all for watching. Thanks for everybody that participated in the live stream yesterday, and we'll talk to you tomorrow night. And if the markets do collapse and get really crazy tomorrow, then I will do an impromptu live screen. It would most likely be after 1:30 New York time before I would come up. Anyway, folks, thanks again for watching. We'll talk to you tomorrow night.